Hi, it's Brant Keller with the Keller Group here at Royal Shell, Southwest Florida. You've been on our website, registered, amazingfloridaproperties.com. For those of you that we haven't actually physically met yet, um, this is our May 2022 market report. For those of you that already know us, well, here it is, the report as usual. We used to do this back in the day when we were registered investment advisors here in Naples, and all of our clients would ask, what's going to happen with the stock market, the housing market, all of those types of things. Now we've narrowed it down for just the real estate market here, and we're happy to use the same criteria, the same sort of resources to bring you what we think is the best educated guess. Not that it's not going to be accurate, but nobody has a crystal ball, right? So let's dive right in. First off, the question we're getting, and a lot of the hesitation we see in the market by some of you from up north, is that, wow, this is a market bubble. Wow, we're headed into a recession. What's going to happen to the housing market as a result? I'm afraid to pull the trigger. Well, here's a lot of reasons why you shouldn't be afraid to pull the trigger, and a few reasons why maybe you should pull the trigger. Number one, the slide in front of us shows that most of the time when we've had recessions, overwhelmingly 3/4 of the time, we don't go into a bubble. That's number one. Number two, the other thing is one of the big drivers of the last bubble was loose credit, easy credit that led to a tremendous amount of foreclosures. So we're going to dig into the different aspects of foreclosure market. One of those is the forbearance market. This was very relative when COVID first came out and the government said, hey, if you want to, you can put off paying your mortgage payments and so forth. And obviously a lot of people did. I think it was about 9 million people to be exact, actually went and took advantage of forbearance. And as you can see, this number has dropped substantially over the months since COVID, since that program, as people have come out of forbearance and paid back their loans, different things. 37% were paid in full, 44.5% worked out repayment plans. There's about 18% of the population that's still in trouble, but that's a super small amount relative to what would be considered a stressor on the housing market. Then if we look at foreclosures as a whole, and one of the things that drove the crash of 2008, 1999 to 2021 were incredibly loosey-goosey lending standards, which do not exist currently in this market. One of the reasons is because of regulations that were put into place to prevent this from happening again. And if we look at the foreclosure activity as a whole, those of you that are investors that we do flips with and things like that, you know for a fact it's almost impossible to find a great opportunity in the foreclosure market right now. In fact, we're at historic lows. The first quarter of this year, 2022, saw only 78,000 properties in the U.S. in foreclosure versus almost 3 million at the all-time high of the housing debacle. So we're nowhere near that. The lending activity has gotten super tight. In fact, it's very difficult for anybody to get a loan that has a credit score less than 620. Whereas you could see back in the loosey-goosey days of 2003 to 07 that led up to the first crash, the last crash, I should say, everybody was getting loans. Mortgage debt is also not a big challenge because of historically low interest rates and the fact that people were bringing more cash to the table, probably taking it out of the stock market, which if you look at what the stock market's doing now, real estate's not a bad alternative by any stretch. About 3.8% is the total debt service of a household right now that's holding a mortgage. So that's like nothing compared to twice that in 2007 and certainly almost twice that in 1991. In fact, we're lower today than we were back in 1980. So these things right here set up for the fact that there is less likely to be a housing bubble or a market housing crash. Okay, don't confuse that with a stock market crash, but a housing market crash or bubble is less likely. Now, there will be states throughout the country that will start to see housing slow and price reductions creep in, and certainly will not have the type of housing performance that we've experienced over the last few years. Certain states like Arizona, Florida, Tennessee, North Carolina, and a couple others are not going to probably see that type of correction. In fact, if we look at as a whole, the entire US, the forecast right now is pretty strong that 2022 will probably have about a 9% price appreciation nationally. Now, that's pretty paltry compared to what we've seen over the last couple of years, but nonetheless, it's positive. And here's the subsequent years going out even to 2026. So while housing price appreciation will slow to a very slow pace compared to what it has been, it's not anticipated to crash. This is just another way of looking at all the places that have been polled, all the panelists, all the different economic advisors, all the different banks, etc. And finally, on average, we expect to see a 6 to 9% increase in prices over 2022 when we average everybody that was polled. Now, one thing that is happening is the Fed is on a rampage to fix inflation. Whether right or wrong, they are raising interest rates. And I believe that you will see 6% or slightly higher interest rates by the end of this year when it comes to mortgages. And what that means, if you are holding off, looking for better prices that probably aren't going to happen in this market, not significantly anyway, maybe 3, 4, 5% price adjustments, but nothing significant in this Florida housing market. If you're borrowing money, you're losing purchasing power. January 2021, based on, again, a $300,000 basic loan amount, principal and payment, the average interest rate was 3% from the Fed. That was going to be your mortgage rate. You'd be about $1,279 on a payment. Right now, we anticipate by October 2022 to be close to 5.5%. If that's correct, that's a $1,700 a month payment. The difference is almost $500 a month. You will not have the same purchasing power. So while you might save 3 to 4% on the price of a house, you will be buying less of a house if your intention is to finance, which means now's the time to act if you hadn't already taken advantage of these ridiculously low rates before they started to rise this year. That's it for our market, May 2022. Again, we are starting to see, even in this Florida market, some price adjustments as we're going into the summer. This is the opportunity to possibly take advantage of 3, 5, and in some instances, if you're using us to negotiate, even 10% less on certain properties. For more information, all you have to do is reach out to Donna and myself. You can call us anytime. You can text message. You can email us back from this particular email. And if you'd like more information, we are available to go out and look at properties for you. We're more than happy to assist you in any way that we can. Thanks for watching. I hope it wasn't too long.